Hello and welcome to the Harwood Report, presented by Trade Academy. Today is October 30th, 2017. I am your host, Keith Harwood, the founder of Trade Academy. We had some technical issues yesterday, so we're going to do this live during market hours, basically, and I'll give you guys a little rundown of what I'm seeing so far this morning, as well as sort of the daily charts that get me a little bit more excited coming into the week. Normal disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Read the rest of the disclosures here. The key here is that none of this should be considered trade advice. This is all stuff that I am looking at. Before you enter into any trade, I think you need to do your own due diligence. Do not consider these to be trade recommendations by any means. These are just things that I am looking at. Changing up a little bit, I'm going to really focus on gold and oil going forward. I think that's some of the feedback I've gotten, that people really like the gold and oil sections as a way to get a little bit of different perspective there. I'll still do a rundown of the equity indices because the way that the equity indices move do have some impact, particularly on gold, but also on oil, and they are impacted by gold and oil moves as well. So with that, let's get into it. Fear and greed first is my first point here. That's 71. A lot of people would have thought that move on Friday would have pushed this to some extreme level in the 95 type range. It doesn't happen that way when people are buying puts and they're not buying everything. There was not that much buying in things like small caps on Friday. So people buying puts to hedge, that helps keep the fear and greed a little bit lower. It also means that on a pullback, people are hedged. So we don't have to worry as much about this major collapse, barring a new piece of macro information. I'm not as worried that the entire market is overstretched one direction. Yes, they're along a lot of NASDAQ stocks, but those earnings came out really good. I don't see people panicking to sell Amazon and Google after what happened on Thursday night and Friday morning. So that gives me a little bit of a backdrop on the kind of froth in the market, and I don't see it being too frothy. Now let's go to the major macro sectors here. S&Ps we see started a little bit weak today, but are firming back above the previous all-time high, which was 257.51. Obviously, Friday's all-time high, 257.89. I don't see anything major to trade here in the S&Ps. I expect to see us kind of drift higher up until Apple earnings. Apple will determine the next direction, as well as potentially the next Fed president choice, which is supposed to happen this week. Powell, that's a little bit less bullish for the dollar and maybe a little bit more neutral for the market. If it's Taylor, that's expected to be a lot more bullish for the dollar and might put a little bit of fear into the market because of expectations of more rapid rate hikes. Good for certain sectors like financials, could be bad for others. We go over to the NASDAQ. That was our big winner on Friday. It's going further today because it's really hard to sell when you get a move like that on Friday. It's hard to justify selling on Monday. I mean, Apple's going to be the next determinant on this. So if I'm not necessarily interested in being long on this prior to Apple earnings and new all-time highs. But what's my value in being short? Anything I do in this, it's going to have to be optionalized, because if Apple earnings are bad, maybe that gets this nice pullback down towards 148.5. If Apple earnings are good, who knows? I mean, 155, 156. I mean, the sky could be the limit here. So I'll take a look later this week on some short-dated options for some leverage, but right now there's not a lot I want to play here. It's going to be on Thursday, looking at the next day's options as a lottery ticket, as a way to play Apple instead of using Apple's earnings. Or Apple's options to play Apple earnings. It's a little bit of a nuanced thing, but given how big of a component Apple is in the tech sector, I think that might work for me. Finally, Dow Jones. Oh, I skipped small caps. We'll go small caps first. Small caps are, as I mentioned before, a little bit they're dead sideways. Until I see S&Ps break out to a new all-time high, I don't know if there's anything I want to majorly do here. I think if the S&Ps continue to firm, small caps are going to have to get some money flow. Everything can only get so far above one another before the laggers start to catch up. Small caps get hurt a little bit by things like the Manafort indictment, because people get a little worried about the United States. But generally speaking, a firm dollar is firm for small caps. And I'll get into the dollar a little bit in the gold section. But overall, there's nothing like major red flags in the small caps. It's just that there's not, they're not getting the Amazon and Google type earnings to help pull them higher. I think what we need to see in small caps to firm them is probably a little bit higher rates, because higher rates tends to firm the dollar, which tends to be good for small caps. And financials are a big component of the small cap, whatever allocation, I guess we could call it. Finally, Dow Jones. This is very sideways as well. This is a lot like, I don't know, it's somewhere between, I guess, S&Ps and small caps. It's had a few days of consolidation. S&Ps have Apple in it, and that helps get them a little bit firmer on Friday relative to the Dow Jones Industrial Average. So Dow Jones is going to be driven, I think, by the S&Ps and the other sectors. So for me, it's such a derivative play that I'm not necessarily looking for anything major here. It's holding above on the moving average. Everything looks good. But for me, I don't see the catalyst that gets Dow Jones to be the leader or the major lagger. If I want to play for a catch-up move, it's in small caps. If I want to play for a big break, that also might be in small caps just because that's at the weakest point, so it's got it's closest to stops. Breaking below the box here and pressing against these lows, we could hit some stops in small caps. And getting above highs, we should see some stops in small caps. So I kind of like small caps as probably my most likely place to play because it's had this consolidation period and has the most likelihood of people getting aggressive buying on a breakout or selling on a breakdown. But let's go to the stuff where I actually see a little bit more leverage and some interesting trades here. So we're going for the gold stuff here. Dollar yen is a little weak this morning, but not crazy. I mean, Friday's low was 113.34. The 10-day moving average is 113.34. That's a key point for me. Generally, when we're between the 10 and the 20-day moving average, it signifies a little more chop, makes it hard to go long outright options. But if this level holds, if Taylor gets selected as the next Fed president, this could rocket. So that's the key. Trump said that he would pick his next Fed president before his trip on Friday. It's between Powell and Taylor. Most likely going to be Powell. Taylor gives some tail risk, where if Taylor is selected, everybody expects the dollar to firm, rates to increase drastically, and be very bearish for bonds and precious metals. So let's look at gold. It's not doing much today. Had a nice bounce back on Friday morning. Looked ready to take out this previous low and just tank, and then it bounced back instead in the morning. Held well at the 200-day moving average. If that dollar starts to firm, though, and we take out these levels, I'm thinking 115, 116 range is a reasonable target for this. That's a pretty good downside here from where we're at. And what does that do to some of the other derivative plays? The miners, I'm not sure 21 even holds at that point. You got the triple bottom there. If you've got gold down there, I mean, I would think that this is going to push maybe down all the way to 19. That's really bad for miners if gold breaks. And if gold holds, if the dollar starts to break, I'm looking at, gold going back in here into this 125 range. If that happens in GDX, I'm looking at a move into this 24.5 range. So I'm watching gold very closely because it's got some drivers here. I think GLD might be a little more interesting on the downside, just because this is going to have a lot of support here, down $1.50, and GLD is kind of testing support levels. GDX has a little more upside because vol's cheap. I'll get into that in a moment. GDXJ, very similar to GDX, but a little bit closer to some of the recent lows. So that's got some good upside as well. Could press towards 36 if gold firms. And then we've got silver. SLV, this is the one that I actually like the best on the short side because when gold was testing those previous lows that it tested on Friday, it's about $1 off of the lows made on this day, October 6th, and silver is 42 cents away from there. So if gold starts to take out stops, silver tends to play catch up quick. And if that happens, silver's well below the 15.5 strike, which is actually very cheap. Option in many of the terms because of this status of sitting at 1585. So let's look at some of the options here in SLV. Let's go straight over to the November 24th. So you see vol below 17 in November 24th. These 15.5 puts are offered at 13 on a chart here. Last 6 months, vol doesn't really get much below 17%. Traditionally trades closer to 18 or 19. Maybe all the way up to 21. Traditionally, these high points are going to happen into a rally, but if we see a quick move to the downside, I think vol comes up towards 19% pretty quickly. To get an idea of the sale here, 18% vol puts these worth about 15, so they're only a little bit on sale here because of how dollar cheap they are, but they give a lot of leverage. Remember, 15.42 is the previous low. That would be 8 cents in the money if gold starts to break. So I like SLV to the downside because of the magnitude of the fall it has, more so than the cheapness of the vol it has. If I'm focused on the cheapness of vol, that's GDX for me. And here's why. In GDX, I've talked about it a lot, 21% is very, very cheap. And on a yearly basis, I mean, vol could get into the 40s again if stuff gets crazy. I'm not looking for a play into the 40s right now. I'm thinking more on the short term, vol could get easily towards 25%. So if I go to November 24th and put, say, these November 24th 23.5 calls, type in 25%, they're worth about 28 cents. These are about 20% cheaper than they would be if vol was at 25% in a more normal range. So you can see that that's on a pretty good sale. And traditionally into a rally, GDX vol will firm. So that's why I like the GDX side as the call side, because it had a little bit more of a pullback, has a little bit more support below, and has a little bit more upside if vol firms. SLV to the downside because of the magnitude of a drop that I can see happening if we start to hit stops. Now we go over to oil, and first focus on where oil itself is. It's pulling back a little bit from the highs of the day, but basically unchanged. A couple things that I want to note here, though. Brent oil is above $60. Hasn't been there in 2 years. Last time it was really above 60 bucks. It was here in July of 2015. That's a big level. A lot of producers, offshore and whatnot, really like this price above 60 bucks. They can start to hedge with futures and options by hedging with their exposure in the Brent market. If you go to crude, similar concept, but really it's the highs back then were around 55, 56. We should see some hedging by producers here, but that means that the producers should be finding ways to make money here. And yet, when I look at XLE, it's just starting to get some money flow here, just getting back above a couple of the moving averages here. The 200-day moving average is 67.83, currently trading just below that. With oil prices where they are, I mean, these oil majors should be able to make some money. And yet, the market's not giving them any respect for it. Maybe it's because we've got some earnings right now, and they haven't been spectacular. Chevron earnings weren't great. CVX. The earnings were not very good there on Friday. ExxonMobil had earnings. They were fine. So it could be just a company-by-company issue. And maybe that's why we haven't seen a lot of money flow into the sectors, because people are waiting on earnings. But future earnings should be considered expected to do better if we're seeing firmer oil prices. And one place I actually like playing this as a result is in OIH. You can see the pullback has been more significant here. We're now getting above the 10-day moving average today, 2381. Close above there starts to get a little bit more interesting here. Had a long drawdown here. You're going to have a long run up, especially if oil prices stay firm. You'd easily see a move towards back to 26 if oil prices continue as firm as they are. Because remember where oil is relative to recent history. It's above all these levels. USO on the continuous contract, it's testing the April highs. OIH April highs around $31. I'm not saying that that's where we're going. I'm thinking for the smaller move, I can get to 26 over the course of a couple of weeks. And play that. You can see cheap vol here. It's up a little bit today, but vol has been around 23%. I can get anything around 23%. That's really cheap. Average value really is closer to 27 or 28%. If I go to November 24th again, I got 23% right here on the 25 calls. Vol goes to 27. These are worth 30 cents. So these are trading more than 20% cheaper than they would if vol was in a more normal spot. So I'm seeing a good discount to these options. And if this starts to get a run, it may get some money flow. Money flow oftentimes is chase buyers at calls. That helps get vol bid, and that helps make this play out better for me. So I'm interested in these November 24th, 25 calls, and I'm going to watch those very closely, especially at the beginning of the week, since we've got oil inventories on Wednesday. We've got the traditional API tomorrow after the close, but just continuing to see oil firm and not have much of a pullback. I may have to get into these before the EIA number comes out, and I'll be watching these closely as a result. I just think that there's a lot of potential here. And I get it, November 24th options are a little bit cheap because of Thanksgiving. but the oil market doesn't really take a day off, right? So even though it's a holiday, oil can still continue to firm. You know, the oil market is, the cash market's really open basically every day. Futures market is going to have a lighter day on Thursday, but I think this November 24th contract is a little too cheap. They're pricing out too much for Thanksgiving too early in the cycle. So I think that gets a little bit of an opportunity as a result, and so that's why I'm going to watch November 24th as an early opportunity in a lot of these names. So that's how I'm looking at things to start this week. Reminder, this is the free video we just watched. I also put out a premium newsletter. I'll be posting that in the next couple of hours. And it'll be expanding upon some more technical analysis, some more trading concepts that I'll be looking at, calendars, diagonals, things of that nature that are a little more nuanced and oftentimes actually have a better R&R than the outright options. I try to focus on the outright options here for simplicity's sake, but the calendars and diagonals can really get you paid well when, or pay me well when the market is in more of this chopping, grinding mode. If we get a one-directional ramp, that's great for outright options. But when we chop around a little bit and then drift higher, that's great for calendars and diagonals. So the first month on that premium report is free. Feel free to sign up. If you don't like it, no risk to you. It's only going to go for the first 100 subscribers, and then after that, it's only $49 a month, which is actually also really cheap. So, I think that this is a really good opportunity. It's worth trying out. And like I said, there's no risk to you since it's all free for that first month. And feel free to contact me. Email is usually best, keith@tradeacademy.co, or call me at 312-600-8004. Thanks again, and have a wonderful week.